Hey everybody, welcome back to Dividend Stockpile. Today we're breaking down three of the most popular utility and infrastructure closed-end funds on the market. BUI, the BlackRock Utilities, Infrastructure and Power Opportunities Trust, UTG, the Reeves Utility Income Fund, and UTF, the Cohen & Steers Infrastructure Fund. This video is in response to a viewer request. So JD, thanks for the suggestion, and hope you like this review. If anyone else has topics you want me to cover, leave them in a comment, and I'll add them to the list of videos and hopefully be able to get through them all. So with that, if you're looking for steady income, long-term stability, and exposure to essential services like electricity, water, energy, and infrastructure assets, these funds are absolutely worth understanding. So let's dive in. So let's start off with a very high-level overview of each closed-end fund, or CEF. If you're not familiar with CEFs, check out the video popping up right now on the screen so you can learn the basics of closed-end fund investing. Alright, so with that, let's get into it. So BUI is an equity-focused utilities and infrastructure closed-end fund from BlackRock. It started in 2011 and has typically around 50 holdings. They do not use leverage, and they use option writing to generate additional income. So this one is good for a defensive equity position and premium generation from the options. UTG is actively managed. It focuses mostly on utilities, but it can go into other sectors, and it's from Reeves Asset Management. This one started all the way back in 2004 and typically holds around 60 holdings. They do use moderate leverage at around 18%. They are focused mainly, as I said, on high-quality utility companies, and they're known for their long-term distribution record. Moving over to UTF, it's a globally diversified infrastructure closed-end fund from Cohen & Steers. It also started in 2004, but this one uses meaningful leverage, almost 30%. They invest in regulated utilities, toll roads, railroads, airports, and midstream energy, among others. And they have a very high number of holdings, around 280 on any given day. Okay, so let's talk about performance. BUI has been the lowest volatility option, but it also has the best returns. UTG is pretty stable, but it does have lower returns, but it is more defensible. And UTF is in the middle, thanks to this global infrastructure exposure that can navigate through different cycles. So for the one-year returns, UTG is about a 12.64% return, BUI has a 16.08% return, and UTF is negative 1.14 for the last 1 year. Looking further, longer term, 10-year returns, UTG comes in at 10.65% average per year, UTF at 10.75% average per year, and BUI outpaces both of them at 11.61% average return over the last 10 years. Looking at the distributions, because as income investors, that's what we're mostly focused on, there's a variety of ways they get to this distribution. So BUI has a steady monthly distribution of around 16 cents per share, which comes out to a current yield as of today at 6.37%. A lot of the distribution comes from the options premium, and it has a lower yield but smoother net asset value behavior over time. UTG has a reliable, consistent distribution history and has a very steady dividend flow because of the heavy focus on utilities. It has a moderate yield but is extremely dependable at 20 cents a share a month, which comes out to 6.61% yield as of today. And UTF is often the highest yield of the three, and it currently is today as well. It pays 15.5 cents per share per month for a current yield of 7.88%. And this comes from dividends, the leverage, and capital gains. But it does have higher sensitivity to market cycles. Now let's break down where exactly each of these funds actually produces the income they pay you, because this is where it really starts making a difference. So BUI has options premium and dividends. So they do a covered call writing strategy. So they write calls on their portfolio to generate income. They currently have about 9% of their portfolio what they call overwritten, which means there's a call on a stock, and it does individual names for its options. This additional cover call writing creates cash flow even when the markets move sideways or when dividend growth isn't strong. It does receive a lot from dividends as well, though. Utilities and infrastructure companies typically pay steady dividends, but the option strategy definitely helps the distribution. So the result is a conservative payout, lower volatility, but the upside is capped because of the cover call writing. UTG uses dividends and conservative leverage to produce this income. It holds things like gas, electric, telecom, and cable companies that have predictable revenue, so the dividends are pretty reliable. It only uses moderate leverage, which helps boost the portfolio income without introducing excessive risk. It selects companies which have high free cash flow to support the long-term dividend growth. UTG is one of the most stable income profiles in the entire closed-end fund universe, and the distribution reliability is a hallmark of UTG. And finishing up with UTF, it has high leverage and has income from global infrastructure, and it uses capital gains for the distributions. So you get exposure to toll roads, airports, pipelines, utilities, railroads, and other water services. They do use high leverage, almost 30%, which amplifies the income, but also adds volatility. And they also use capital gains from active trading. You do have exposure to some higher yielding assets like midstream, energy, and transportation, but you do have more volatility in those spaces as well. So the result, it typically has the highest yield of the three, has strong income and total return potential, but it is more sensitive to interest rates and market swings. Looking at the portfolio composition, BUI has equity only, is heavy in electric utilities and renewables, and it doesn't use leverage, as we talked about, to keep the drawdowns milder. UTG is primarily US-centric, focuses on long-term compounders in the utility and communication space, and it definitely has a defensive tilt. UTF has a broad global mix, includes transportation, energy infrastructure, and international utilities, and is definitely the most diversified of this set of closed-end funds. So let's talk about some expenses and the risks. So I would say the BUI has the lowest risk because it doesn't use leverage, and the option strategy helps reduce volatility. UTG has moderate risk, again it has some leverage, but their stable holdings offset that. UTF is definitely the highest risk because it does have the most leverage, and it uses cyclical infrastructure assets. Looking at expenses, all closed-end funds are relatively expensive, but it is an active management, so you have to take that in consideration. BUI has the lowest expense ratio due to it doesn't have any borrowing costs. The total management fee right now is 1.08%. UTG has a management fee of 0.94%, but because they do use leverage, we do have to pay the interest expense, which adds another 1.49% to the annual fee for a total of 2.43%. UTF has a 1.2% management fee, but because it uses a lot of leverage, the expense ratio is high. The interest expense is higher at 2.47% for a total expense ratio of 3.86%. As we mentioned before, UTG and UTF both use leverage, and anytime that happens, the fund passes those fees on to the investors. But again, as I said, all three are typical for active closed-end funds. So valuation makes a difference in when it's best time to purchase a closed-end fund, and at times, closed-end funds will trade at a premium or a discount to their net asset value. And it's usually a good time to buy when there's a discount to the historical ratios. So right now, BUI is running at a premium of 0.67%. The 5-year average is a premium of 0.13%. UTG is currently selling at a discount of negative 1.71% to net asset value, and their typical 5-year is at plus 0.56%. And last up, we have UTF. It has a discount of negative 7.52%, and it typically trades at a positive 0.87%. So there might be some value there. So I hope this helps you understand the choices that are out there in the utility and infrastructure closed-end fund space. Remember, this is not financial advice. Please do your own research. This is just my research and my opinion. I am not your financial advisor. But if you were to look at them, I would choose BUI if you want low volatility, you like having options in addition to dividends, and you prefer no leverage. You would choose UTG if you want some really steady distribution, you value a higher exposure to utilities, and you like using moderate leverage, but not too much. And then you have UTF. So if you want maximizing potential total return and you're comfortable with high leverage, this might be a good choice for you. It also gives you more global infrastructure exposure that you wouldn't get in the other funds. And if you like a high yield, this one's usually pretty good for you as well. So there you have it, BUI, UTG, and UTF. They each bring a different flavor of income and risk. Again, BUI is conservative options income, and it has a smoother ride. UTG is dependable distributions and high-quality utilities. And UTF has higher yield and access to global infrastructure. But it also uses a lot of leverage, which should help or hurt depending on the market cycle. So let me know in the comments, which one of these fits your portfolio and why. If you found this helpful, hit the like button, please subscribe, and share it with a friend. Thanks for watching. I'll see you next time.